Welcome, everybody. Welcome to 2025. I guess this is our first official Steady Wealth podcast here for 2025. And what better way than to start it with my good friend and colleague, Brian Terry. Brian, Happy New Year to you.
Happy New
Belated.
Year. Yeah, how you doing?
I'm good.
You
I'm
look
good.
well.
What's that?
I said you look good.
Yeah, well, thank you. Likewise. Because I didn't comb my hair as nicely as you did, but it's more difficult with these things on my head.
No, yours is way sportier than me.
Yeah, I don't know. Yours is definitely better in the wind.
That's true.
That's for sure. Mine, you don't want to see it. I was on the driving range yesterday, and it must have been messy looking at me. Anyway, look, we just wanted to talk markets a little bit, you and I. I think, just to give you guys a bit of background, if you don't know, Brian, he does a lot of option strategies, be them on the income side or directional stuff. Really, really great stuff. And from credit spreads to debit spreads and things that get even much more interesting than that. So that's sort of where Brian's focus is. But of course, we all have to look at the market first. I mean, I'm just going to fire off a really big picture question to you, and we can kind of go from there. What do you think about the market here? As we're recording this, we're a couple of weeks from inauguration. Right. What do you see? I mean, again, things can change quickly this year, right? So I've been declaring it sort of the year of the trader. But what's your thought right now?
Yeah, I mean, I think it's a very choppy, headline-driven market. It's also, being impacted by, the treasury yields, which are going through the roof. And I think, in my opinion, everyone seems to be obsessing with rate cuts. So every economic report, they're like, well, what does that mean to rate cuts? And if it's a good report, the market doesn't like it. If it's a bad report, they seem to say, well, we're going to get rate cuts. So to me, that's almost like an obsession to rate cuts as opposed to, what's the dollar doing? What are treasuries doing and things like that.
Yeah, I mean, I know we've said this for a long time, but we've gotten, the market, it's almost like a junkie. We've gotten sort of reliant on lower rates. And it's actually, as you mentioned this, I might as well bring up a chart if that's okay with you. Might as well have a chart on the screen. And for those of you guys that are listening to this on traditional podcast channels where you don't see the screen, we will talk about these charts here. They're not, too detailed, so we can easily talk about them. But let me quickly share my screen here. So what you're saying is the yield, right? So that's what we're looking at here. That's this chart, and it's a global thing. Bond yields. This is U.S. Treasuries, but bond yields are globally higher. And so essentially, what's happening is the United States is actually exporting inflation, and that's actually very, very interesting and it could lead to problems in the equity market. And we say could because we do want to be open-minded to, of course, the trading opportunities in all directions and the way the portfolio has to be setting up. But right now, as you say, we've broken out. We essentially broke above 475 or 470 on the 10-year. Again, very similar charts in Europe, France, Germany, so on and so forth. Really across the globe, the only one that's standing out that's doing the exact opposite is China. Those yields are actually going down. That's very interesting. But the 10-year, maybe towards 5%. And what's actually happened? We are recording this here on. We should mention this on Friday, just after the December jobs report here in January. This is what happened today after that jobs report, which was very strong. Mm-hmm. You can see the rate cut expectations have essentially collapsed. That's all the way on the right on the screen. And I think that's what you're alluding to as well, right? The market's very, very focused on these economic data points.
Yeah, I mean, we were at 4 rate cuts, and then we cut to 2, and then today's kind of thing kind of says, well, we're down to 1 rate cut. And I've even heard some of the people on the Fed saying maybe we don't need another rate cut, which that's going to make any trader nervous, in terms of the ones that are reliant on seeing the rates get cut. And The other interesting thing, Serge, was to see the Fed minutes where they were saying we're worried about the Trump policies and how that
Yeah.
might inflect inflation. I think that adds another layer of stress or worry into the overall market.
Fully agree. In fact, if you look at this a little bit closer, what's actually happening is typically when you see a really good jobs report that we just had. I mean, it really was. What was I think 160 was the average sort of consensus on the street. We had two
Double
sixty or
that
two
almost,
fifty,
yeah.
whatever, 240, whatever, within that vicinity. Way off the mark as they usually are. And listen, it's a hard thing to guess, right? So I'm certainly not going to criticize anyone for being off. I mean, it's just a hard thing to do. But it caught the market by surprise. And interestingly, the reaction function here, right? So this is a good jobs report.
Mm-hmm.
So the
Great
equity
jobs.
market, you would think, would have to bounce. And as we're recording, and again, by the time this podcast come out, who knows where the market is, but the initial reaction was negative. And I think more interestingly even is typically when you see such a good jobs report, gold actually typically goes down 40, 50 bucks. And gold is actually up.
It's ripping higher.
Yeah. And so what does that tell us, right? That's the question. So I have a chart here. I put this together the other day, late at night. And then it still made sense in the morning, which is always good if it still makes sense in the morning. But this is a long-term chart of bond yields, which is the top line versus the price of gold. And so you can see there for a while there was really not a whole lot of correlation between these two things. But what's happening now is that the correlation between bond yields and gold is actually nicely positive for the past number of years now. And I think the reason why is because people really are, when I talk to institutions, and I'm sure you can see this yourself, people are concerned about this debt level. And so they're actually saying, okay, higher yields, well, I'm going to maybe buy less treasuries and buy some gold. So there's that positive correlation. And we know the Chinese, they haven't been necessarily buying gold as much as they've been selling dollars, and with those proceeds as a result buying gold. So you have all that happening, and it's not very normal to see this, by the way.
Yeah. I mean, gold's up over about 1% today, which is
today
huge...
as on Friday. Again, obviously when people watch this, who knows?
Right.
And then to your point as well, just while I remember what you mentioned before, and this is well published and talked about, so it's not necessarily anything new, but people need to understand that what the bond market's doing is not normal now. The Fed cut rates 3 times, once in September, once in, October, and then of course in December. And the Treasury market yields on the 10-year are now 110 basis points higher, 1.1% higher, even though they cut rates.
Right.
So clearly this is a long conversation. This is the higher inflation for longer story. It's the debt story. It's the whatever. I mean, as an equity trader, at some point, you have to be a little bit concerned, don't you think?
Very concerned. I mean, I think, what in my opinion, you're seeing just, like on the intraday kind of thing, you'll see a rally up in the morning and a sell-off in the afternoon, or vice versa. And, and it's very fragmented, like certain sectors are doing very well. And then other sectors are really, really struggling. So, like you said, that it's going to be a trader's market this year. And I think that's even more so than, even previous years, which we used to always kind of look at what sectors are doing well. But now you have to say, well, what sectors do well in a high interest rate environment and things like that. And gold kind of obviously one of the ones that popped to mind. But and then you also have still a lot of political thing, like oil is popping today because of political tariffs, things like that. So you add all that stuff together, that makes it for a pretty nervous market, in my opinion.
Yeah, and people forget. I mean, we can pull. I'll pull up 2 favorites here, the 2 all-time favs, or at least recent favs of the past 5 years, and that'll be the S&P and probably Nvidia. So the S&P, I mean, again, as we're recording this, obviously people watch this different times by the time this is published. In a few days from now, who knows where the market is. But as of right now, the reality is that we've given up all pretty much of the post election gains. The S&P is now exactly more or less where it was on November the 5th. Right. So we've given up those gains. So the S&P, as we are recording this here, is basically at the same level as it was in mid-October. And then, of course, the one that really no one wants to hear, like people just stick their both hands in their ears. They don't want to hear that NVIDIA is actually, as of this recording, at the same level it was in June of last year. Right? You would think, given the headlines and CEOs, I keep saying this, autographing bras and just ridiculous stuff. They don't want to hear that NVIDIA hasn't done anything in whatever 6 months, but it's the fact.
Yeah, I mean, there was a big kind of AI rally. Don't you agree, Serge? Where like any earnings report, if they mentioned AI, it was positive. I think, potentially that's become a little bit kind of, they're not as reacting as much to that. So, you take a NVIDIA, perfect example, right? Everybody's darling. They're in the Magnificent Seven. They've really struggled, right? They're just kind of in a range bound and can't get above that resistance level to save their life.
And this is not to say, and hopefully I'm not putting words in your mouth, but I don't think neither you and I are saying we're thinking this is a bad company.
Oh, no. I mean, it's a great company and probably a good long-term holding, but it's not going anywhere right now. And even that whole sector is kind of struggling, right?
And that's always the chasm, right? Between, do you want to make money or do you want to just believe in a story and come hell or high water, you're going to like that story, and then ignore the time frames? Because, we always talk about having multiple buckets, multiple time frames, or having your trading time bucket, be that, multiple days, multiple weeks, and then your investing bucket. And I think a lot of times it's hard for people to understand that there's different time frames. I just finished up a 3-day boot camp for clients, and you could tell, excuse me, and you could tell it's a struggle for people to think in different time frames. I wonder why, though. Like, have you ever given that any thought?
Well, I think that if you're a swing trader or even a day trader, it's hard to pull back and take a look at like where's the overall market going to be. Like I have some friends that trade 0 DTE stuff, and they have no clue what the overall market is going or any. It's just like they're so dug into the minutia, and that's one thing I've always learned from you, Serge, is that you got to look at it from multiple time frames. Like don't just look at an hourly chart. Don't just look at it. Look at it, the weekly, the daily, even the monthly, to get a better perspective of where the market is. And the more you pull back and have a good idea of that perspective, then you can dig in and make better choices.
No, I agree. It's time frame analysis. It's it requires a bit of work, and I think that maybe that's why people shy away from it. But it's important, right? It is. And speaking of time frame, oil, again, as of today, it's having a big move. Again, it's breaking out along with this higher inflation for longer theme, which we can talk about a bit. Along with this, I do just have to get your thoughts too on the whole energy space. I mean, I've been talking about this now for a long time, that I'm very bullish energy, again, for the higher for longer inflation theme. And we're starting to see stocks. I know there's names that I've seen you trade last year as well. They're starting to wake up, and they look good. They had a bit of a scary pullback, the energy sector, in the fourth quarter, and it was a bit hard to explain to people why that is. It was all fund flows, fund managers having to sell down stuff that doesn't perform, and then of course, that lasted until Christmas, and then they had to buy it again. But when you look at when you look at a chart like, I don't know, I mean, let's take natural gas. I think because this is an interesting one to kind of look at. This is more of a bit of a charting thing we're getting into,
Mm-hmm.
but and I will say natural gas is very volatile, right? So
Yeah.
let's keep that in mind.
I have some covered calls in natural gas,
Okay.
UNG, and it's like one day you're a hero, and the next day you're wishing you never
Totally,
heard of it.
well, they call it along with silver. It's a widowmaker.
Widowmaker, yeah,
And for good reason. It's just brutally volatile.
right.
However, we're seeing a pattern here, and natural gas. Every time you try to call a bottom, of course, you get, as you say, woken up, and you get clocked. But there is a very clear theme here of the higher inflation for longer, and it's playing out again. Early days here, natural gas, but the energy complex in general. You look at Chevron. For example, which is basically range bound.
Mm-hmm.
But again, if you zoom out the chart, and that's really what I'm trying to get to, long-winded way of getting there, and you look at this, let's say in a weekly time frame, this is not exactly a bearish looking chart. If you're very, very simple about it, and then you take the Y into account, which is, I want to touch on that because you had a great comment to me before we started rolling here around that. I mean, this to me, all it is we're basing above resistance,
Right.
and ultimately we might break higher. What do you think about that?
I think the energy stocks will be a preferred sector if as things continue to get more risk off environments. So I think that these guys pay great dividends. They're good long term. They have low beta, and most of them have a good weighted alpha. So those are the ones that I think people are going to gravitate to when they don't want to be in the the Nvidias or Palatars or the real high flyers that, or even natural gas kind of thing. But those are the ones that are going to hold up a portfolio on a longer term basis.
And you could even get, I mean, one of the arguments I'm making, Brian, again, wondering your thoughts here too. Obviously, tech is growth, right?
Mm-hmm.
Or a good amount of tech is growth. I actually think that we could see, at least for a while, and that could be multiple years, the energy sector actually becoming the new growth sector. Because if you go deep enough into this and you see the supply and demand imbalance, we're something like it was a ridiculous amount of money. It's something like $2 trillion underinvested in for even just current demand globally for energy, the energy demand.
Right. Yeah, I mean, I think you're going to see a lot of, even though we're trying to cut down on you need utilities and gas to fund a lot of these green energy things. So I could see, and like we all know that, our energy grids are outdated, need to be updated, all those kinds of things. And I think you add that with kind of a safer, more certain sector that pays good dividends. Pretty hard to at least not have some of your money in that sector.
Totally, and that is, and I think you're speaking a bit more on the allocation side, but I would also venture to say that from a trading perspective, I know Valera, pulling it up here, is one that you've had your eyes on last year several times.
Right.
I mean, this thing, all it's really doing is checking back to really, really good support, and ultimately, they all look the same. These names, I should say, right? They all look the same, except some of them, like Kinder Morgan, which on the market rover, for those of you guys that use that, has been bullish now for some time. It's already broken out like crazy and is giving off another buy signal here. This is more near term, obviously, but I really think this could be a growth sector, right? People don't think of ExxonMobil as a growth company because it's not, but the kind of name like Exxon, maybe not necessarily Exxon itself, it could turn into an actual growth story. And I think the demand is there. It's more people are still holding on to, the Nvidias in the world, and there's nothing wrong with as we said before with that company long term, but people have to think about what that means from a growth perspective and the higher interest rates, right? So you have something called a discounted cash flow model, right? DCF,
Right.
very basic sort of finance stuff. And the higher rates go, the lower your net present value on a growth stock like Nvidia. That will matter at some point, at least for a while, right?
For sure.
So
yeah, and I just I try to just take it down to a real basic level. It's like these are the stocks, the Exxon Mobil's, the CVX that are going to be, people are going to rely on that. So there'll be more demand in those stocks just because of their kind of not safety but growth potential, plus not kind of the up and down like you see in a lot of other stocks. So like you can look at like today's market action, and it's scaring a lot of people. You hear it from your clients just like I do, that it's like, oh, what do we do, what's going on? And there's no really quick answer like with the interest rates going up to solve them. So I think it's going to be something we're going to deal with all year long.
Yeah, and to sort of be on upbeat about this, and I always walk this fine line between trying to make clear to people that I think there's a lot of opportunity, but also understanding like what will create that opportunity is probably some kind of fear or some dislocations to some extent, not market crashes. That's a outlier forecast, but just So and I fear truly for a lot of people that are consider themselves self-directed traders who've been in the market for maybe as little as 5 years, maybe 10 years. You've seen one market and it's directionally up and to the right. And it doesn't take much for that market to just stall for a while, multiple years.
Yeah.
And whatever strategies they deployed, which is very simple, is they bought the dips, whatever dips there were, and then we had new all-time highs, but that can stop for, a long period of time.
Right.
I'm not sure that, in fact, I'm very sure they don't know what to do in that situation.
Yeah.
I mean, they might panic.
And that's the worst thing, right? You don't know what to do and you panic, and then you make, bad decisions or decisions you didn't think through all the alternatives. So that's the down, the worst part of this kind of market environment is it causes really smart people to make not the smartest decisions.
Yeah, no, fully agree. So, I guess, to be sort of, preparing for this, and it's hard, right? Because human beings tend to be reactionary than sort of you're trying to anticipate things too much, at least actually financial markets, because there's so much fear and greed.
Mm-hmm.
But and obviously we can't give advice here, but it's a good time right now, and it was probably 6 months ago, to look at your portfolio and see, hey, how much am I exposed to basically the direction of the S&P 500? And for most people, at least here in the US, the answer is probably almost 100%.
Exactly. I mean, and that hasn't changed, right? It's just now that there's a consequence to that if the whole market kind of changes. So I think it's good to get a second opinion, see where you're at, step back, and and kind of rethink how am I going to trade and invest in this kind of new changing world.
Yeah, no, absolutely. And again, think, maybe sort of last sort of point here, think in terms of not so much linearly. In other words, what happened last year is going to happen again this year, but things can change quickly.
Mm-hmm.
I mean, look at and this is rates, for example. Like, who thought that we would go from 50 basis point rates to 5%? Number of years ago, like literally no one.
No. Yeah.
It happened. So, can tech as a sector start underperforming for a while? Again, I'm not saying crash, underperform. Oh, you better believe it, and at that rate of outperformance it's had, the underperformance can be quite gnarly. So, anticipate, diversify.
Yeah,
I think
for sure.
Thing,
yeah.
Right. So anyway, Brian, thanks for being here.
Hey, it was a pleasure.
Happy New Year. And I'm looking forward to all the trades we can do this year. Really, I've been saying, like, I've been trading more for the past now 2 months.
Yeah.
If I were to annualize it, then I have probably in 10 years. Just because there's so much stuff to do, and we're just getting started.
I agree. I think the more we trade, the more fun we have, right? And it's been fun working with you all these years. So
Yeah,
hope it
likewise.
keeps
It's
up.
always great. They always like your experience, and that's why I wanted to make sure that we have a discussion to kick off the year, and hopefully many more throughout the year.
Yeah. Well, thanks for having me, Serge.
Thank you, Brian. I'll speak to you soon.
Take care.